All right. Good morning, good afternoon, and good night. Welcome to another episode of Know Your Numbers, a Better Books broadcast with Chris McCormick, where it is our job to bring the accounting and finance knowledge to those who need it most. Today and for weeks to come, we're going to be shifting our focus to the real estate world, the investing world, the importance of knowing your numbers in the real estate world, in the investing world, and some of the tips and tricks to find yourself success when it comes to real estate investing. So over the next couple of weeks, we'll be recording some podcasts with some special guests, real estate investors, real estate professionals, lenders, to pick their brain on the importance of knowing your numbers in the industry and what you can determine from analyzing and investing properly and having the right numbers when it comes to those subjects. So to set the stage for the weeks to come, I thought it best to introduce some of the most important and tactful expenses that real estate investors can use to lower their bottom line, to potentially decrease their tax liability, and overall just get a more organized system to their business. So today's episode will be focused on the 5 most important business expenses for any real estate investor. And if you know anything about real estate, if you know anything about accounting, one of the greatest expenses that a lot of people talk about is depreciation. And so we'll start our discussion today with number 1 being depreciation. And the reason depreciation is so special and emphasized is because it is often referred to as a phantom expense, meaning it's an expense that you don't really need to incur any additional cost to use on your books to decrease your net profit, which is that number that you will ultimately be taxed on. So depreciation being a phantom expense often brings into question, some people don't know what that means. And depreciation is essentially the cost of owning a piece of property, whether it be a house, a computer, a car, a vehicle. The idea is that over time, the actual value of that property decreases given the change in time. So over time, it will decrease in value. So if you're familiar with cars, there's an old saying and a true saying that the value of the car decreases right when you drive it off the lot, because you are putting mileage on the car. There's wear and tear, and as a vehicle, it starts to decrease in value. And so they use that same principle when it comes to real estate investing. But the good thing about the real estate investing is that the property will actually increase in value, assuming that you invest at the right time, in the right area, and with the right numbers, the right price. So depreciation is nice because it decreases your bottom line, but you are also more than likely to increase the overall value in the home, given the idea that the market tends to increase over time. So when it comes to depreciation, your properties can be depreciated over a certain time period, and that time period is about 27 and a half years. Excuse me as I look something up. So the depreciation time period is going to differ depending on the type of property it is. And if you have a residential property, you are going to be depreciating it over a 27.5 year time period. So what you do to calculate that depreciation is you take the purchase price that you invested into the property and you divide it over 27.5 years, and that will give you the amount of depreciation that you can write off in the current year. And so that is for any property that is residential in nature, meaning multifamily, small multifamily homes. I think the range is 2 to 4 living areas, 2 to 4 homes under one roof, and then single family homes as well. So you can depreciate over 27.5 years, and that will give you your yearly depreciation, which can be used to decrease your overall profit, which will in turn likely decrease your tax liability. And the other type of property is a commercial property, and commercial properties can be depreciated over 39 years, which obviously sounds like a lot of time, but given the amount of investment that usually entails, it can actually be a large number. And so I'm sorry, I'm looking up just to make sure that I have it all correct, which I do. 39 years for commercial properties, 27.5 years for residential property. And if you're doing a straight line depreciation, which for all intents and purposes, to keep it rather simple, you just take the purchase price and divide it over the number of years, and that gets you your yearly depreciation, which if you're in the real estate investing world and you're not using depreciation, well, you're probably incurring more of a tax liability than you need to be, and we should discuss. Or you should discuss with your tax professional. And one thing I've heard from certain people is that they don't know if their tax professional is giving them all the benefits that they deserve, and if that's the case, then I'd be happy to run some ideas by you. But that's another discussion for now. Just know that the most important and beneficial business expense that real estate investors can use to their advantage is this depreciation. And so the next one that we'll discuss is the interest expense that you might incur on your mortgage. You know, when you take a loan out, you are not only responsible to pay the mortgage amount, but there's also some interest that comes with that, because the bank is lending you a certain amount of money that they expect to get, but they also want to get a little benefit out of giving you that money. So that comes in the form of interest. And that interest expense that you incur is capable of being written off, and you should write it off, because again, we want to decrease the overall tax liability and the overall money that is going out. So the second expense that every real estate investor should know about is that interest expense. Thirdly, and sometimes overlooked, is the repairs and maintenance that comes as a result of owning property. You know, real estate is a very profitable industry. It comes with a lot of value adds because the properties tend to appreciate over time. But one thing that sometimes goes overlooked is the maintenance that it requires. And the fact that you are usually renting out a property, means that you are usually responsible for the maintenance that goes into that property, unless you have some tenant that likes to do the handiwork and has offered to do that for you. You are likely to be on the hook for repairs and maintenance, and as a result, that is an added cost that you will have to incur. But lucky for you is that repairs and maintenance can also be written off. So if you have to fix the boiler or replace some utilities, well, all those can be written off because it is a cost of doing business. Also, another thing to add is that on the utility side, the appliances side, a lot of that can be depreciated. There are a certain amount of years that appliances are depreciated over, and again, we can save that for another discussion, but know that a lot of the appliances and property that you put into an investment property can oftentimes be written off, and that's one thing to keep in mind and to talk about with your tax professional, your CPA. So for the first three, we have depreciation, interest, repairs, and maintenance. Number 4, we will go to mileage and travel. This one is especially important if you have properties in the local area and you yourself are managing those properties. Sometimes people hire a property manager and give them a certain amount to take care of all those repairs and maintenance, but oftentimes you are responsible for the upkeep of your properties, and so the travel that it takes you to get to and from each property can be written off, and it's important to be mindful of that, to note and keep up with the mileage that you are incurring as a result of traveling to and from properties, because yes, it is a business expense. Yes, you can write it off, but yes, it needs to be tracked. It needs to be accounted for, and the IRS, should you be subject to an audit, the IRS does enjoy looking at those types of expenses. So for the year 2021, the mileage rate for travel expenses and mileage is 56 cents per every mile. The IRS does a calculation based off gas prices and all that good stuff, and so for this current year, they have put it at 56 cents per mile. So every mile you drive, as long as it is business related, can and should be written off, and to get the expense correctly, you will multiply it by 56 cents, and that will give you your business deduction for the 2021 tax year. This can also include travel to and from business conferences. It can also include travel to and from properties out of state. One of the beautiful things about modern technology and the modern investing world is that you don't have to have properties within your radius, within your living radius. I could invest, as a man from Boston, I can invest down in North Carolina or Arizona or out in the Midwest, because there are tools to be used and people out there that can go and visit the properties and keep up with the properties for me while I sit in this bedroom and record a podcast. So one of the benefits, though, if I did want to go out there and visit my properties and make sure everything is running smoothly, or if I wanted to look at potential property for investing, well, that can be written off because it's a business expense. You are going out there for business purposes, and as a result, you get a tax benefit. So mileage and travel, keep in mind, those can be written off, but it does have to be for business purposes. And then the last one, which is a benefit for all business owners that we should keep in mind, is the home office expense. As a real estate investor or anybody that is in the current living situation brought to us by the COVID-19 pandemic, a lot of us are working out of our homes, and as a result, you are able to write off a home office expense. And while this is true, it's also important to keep in mind that you have to have an area of your house specifically designated for your home office. If you're working out of your bedroom that also serves as a bedroom, the IRS says you cannot write off that part of your home. And if you're working at a kitchen table that also serves as the kitchen table, you cannot write off that as your office expense. So you need a specifically designed area of your house that will serve as your home office in order to use this to your benefit. But it is very beneficial if you do have that home office, which I know many people do, because the way you go about it is you can write off a portion of your mortgage for your home office expense. So I won't get into the nitty-gritty about how to calculate that, but if you are curious about it and you have not been using this to your advantage, then feel free to reach out to me. Ultimately, it is the percentage of the square footage of your home that is then multiplied by the amount of your mortgage, which is then the amount that you can write off as your home office expense. So it's a great use if you are working out of your home, if you have a specifically designed room for your home office, and you are willing and able to calculate that. But the IRS also does a calculation for yourself. So if you don't have the means to calculate what percentage of your home is your office, there's a calculation that you can use, which again, I could provide you if you are willing and able to reach out. But I believe it's about 300 square feet of your home. But again, don't quote me on that. That is not based off of anything I'm looking at right now. I will do further research and get you the correct answer if you need it. But ultimately, this episode is a precursor to future episodes where we will be interviewing real estate professionals and inquiring about the importance of knowing your numbers in the real estate industry, because it is a numbers-based industry. It is an industry of profit and loss, cash flow, rent rolls, and analysis, where you need to analyze a property to determine if it's a value-add property, if you can buy it at that price and get instant equity. So when we get these professionals on, I'm excited to bring you that knowledge today. It was kind of a boring, more accounting-based, but I did want to set the stage for the people that are coming on, because I am very excited for this series to launch. It will set the stage for business as we continue to grow and develop our knowledge in the real estate world and bring it to you on a daily, weekly, monthly, and annual basis. So thank you very much for tuning in. Again, this is the Know Your Numbers podcast, a Better Books broadcast with Chris McCormick. I am the founder and CEO of Better Books, where it is our job to bring you, the listener, the accounting and finance knowledge you need to grow your business, grow your investments, grow your mindset, and ultimately live a successful and fruitful financial life. So thank you very much for tuning in. I appreciate you. I look forward to the episodes to come, and let me know what you think. I will talk to you all soon. You have a great rest of the week.